I'll be honest with you, I haven't been doing much lately in the portfolio. I don't know if it's the overhang of what's going on in the economy versus the prices that we're actually seeing in the stock market. But I figured today we would do something a little bit different. We're gonna go through my research process for a potential opportunity that I see in the market today to figure out what it is, what the pros and cons are, and where the opportunities sit in the market. And today we are covering preferred shares. So stay tuned, we'll go through and break down everything about this asset class to see if it's a potential add for me and to see if it's something that you can add into your portfolio. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. We'll start off by talking about what a preferred share is, and to be completely honest with you, I do not own any preferred shares today, and I always saw them as more high yield plays paying a higher dividend, but not so much of a growth story. Now in this market, is this an opportunity? Well, let's find out. So a preferred share, first and foremost, have both equity and fixed income elements. They trade like stocks and they represent ownership of a company. They provide a regular payout and have a par value similar to bonds. There's two main types. There's a straight preferred share. They pay a stable dividend forever. And then there's rate reset shares. So we'll learn a little bit about that later. But let's start talking about why they are so important. It's because they are normally offered by blue chip companies. So the credit quality is relatively high. The yields are attractive and the payouts get preferential tax treatment since they're in the form of a dividend and not interest income like a bond. Now, the way that I understand this, it seems like there's three different ways that you can own ownership into a company. The first one is a bond. The second one is stock ownership, and right in the middle, you have preferred shares. So obviously we've talked a little bit about the tax treatment and being more beneficial at the end because you're taxing it as dividend income instead of interest income. But let's read on a little bit more about the pros and the cons. So one advantage is that the dividend on the preferred shares can't easily be cut, unlike common stock, which can be subject to surprise reductions or have a payout eliminated altogether. So the yield is going to be more consistent than if you were to own another company. Making the news right now is TELUS. They're having some troubles right now, and there's a lot of people calling for the dividend to be cut so that they can put that capital to work to actually grow the value of the company. Where if you actually own the preferred shares of TELUS, that would not be a concern. So if they go and cut the dividend, not a concern with the preferred shares, but definitely a concern if you own the stock straight up. The definite downside of a preferred share is the fact that it is an illiquid market. There's not so much trading that's happening in this market as much as you see with common stock. And they suggest a limit place order when you're going in to buy and sell these securities, which executes the trade at a specific price. If you go in on market, you could get a wide variance of what you actually expect to pay. Instead of the price moving with the performance of the company, it's been noted here that the price moves more in tandem with what interest rates are doing, not the common share price. And the moves up and down can be more significant than what you see in the market. So that is definitely something to take into consideration, knowing that we've raised interest rates at an all-time pace since that first month there in 2022. So now that we know that interest rates affect this particular asset class, let's try and figure out a little bit more as to why. So we'll jump over to Investopedia here and we can see share prices of preferred stocks often fall when interest rates move higher because of increased competition from interest-bearing securities that are deemed safer like treasury bonds. We've covered it in videos before. An high interest savings account is paying 4 to 4.75. So realistically, you'd probably rather hold that than deal with something like a preferred share that could drop 15 or 25% in value. So people are moving from this asset class to areas where they can get the same amount of dividend or interest income, but but not have to deal with the capital potentially decreasing or your money potentially decreasing in value. So that is one of the big concerns that we've seen, because interest rates have moved high, which we've mentioned before. People are looking for safer assets to maintain capital, to maintain their investment value, while still benefiting from the higher interest that they're seeing in high interest savings accounts or GICs. I went on to find another article which talked about the Canadian preferred market, and this came out in April 27th of this year, and we can see what the connotation was. So the movement in interest rates had a significant impact on the performance of Canadian preferred shares. Most of the Canadian preferred market is made up of rate reset prefers, which are sensitive to interest rates. As rates increased, the rate reset issues and floating rate issues both took a hit. Now, what do they have to say about that? They have to say what to expect for 2023. If interest rates begin to fall at the end of 2023, so this was the mindset back in April, that interest rates were going to come down. Some time has passed. The Bank of Canada has been clear to say higher for longer. This mindset could be a little bit wrong, but let's continue to read. So as some forecasts predict, then the performance of Canadian preferred shares could improve. Straight perpetual preferreds in particular may benefit from a decrease in interest rates as their share prices become less vulnerable. At the same time, the performance of rate reset preferreds, which is a majority of the Canadian ones, may still be tied to the equity market in 2023. Investors should keep an eye on both interest rate and equity markets in the upcoming year to get a better idea of how the Canadian preferred shares may fare. Another article that I found in the Globe and Mail talked about why it could be a good time to start adding these into your portfolio. And they say the average yield is getting more attractive and there's huge upside potential on your average coupon. If the 5-year rate stays high, investors can reset with a much higher coupon. The real reason to buy preferreds is for the upside. If rates stay high or go higher, which isn't impossible. So next we're going to take a look at where they're performing. We're going to be taking a look later in the video of ways that you can play this on the Toronto Stock Exchange, giving you some examples of the yield that they're paying today. And what they're talking about is that if you're buying today, you could be getting this high yield and you could actually be getting appreciation on the preferred stock moving forward. So let's take a look at how they have performed over the past couple of years. And we can see over the past 5 years, it is not a pretty chart. This is the overall preferred shared index of all of the companies that trade on the Toronto Stock Exchange. And when those interest rates started to go higher in January of 2022, we've seen that these have lost 25% in value, which is not good. Why we're seeing people move towards GICs, treasury bonds, high interest savings accounts, etc. But realistically, these do have bad performance years. And if you could get them lower with that higher yield, you're basically getting that coupon plus appreciation plus potential growth in the future. So with that being said, let's take a look at 4 different ways that you can play this on the Toronto Stock Exchange that I've been able to find. And you have your big products here. Many of the ones that were listed, especially if you look at my Canadian ETF series, we can see iShares, RBC, TD, and Evolve. So this is just a quick snapshot of what their stock price was as of July 31st. And we can see the dividend yields are around that high 5 plus north of 6%, which is great when you look at it in terms of adding yield into your portfolio, which for me personally is something that I like to do. And when you look at what the potential preferred shares can do over the next 2 to 3 to 5 years, you're being paid to wait, which is a saying that I love. You're getting 6% return regardless of what the stock price does in the short run. But if you're looking on a longer term basis, the price of the preferreds could continue to increase. So you have that yield income, and then you could get that stock appreciation value at the end. They do have relatively low MERs at about 0.5%, and we see what the potential return is when we take a look at just the yield income alone. So with that being said, let's take a look. What I always like to do is bring this all into Yahoo Finance to get a better indication of how these have performed in comparison of each other. So we have the iShares product in blue, the TD, the RBC, and then the Evolve product, and we can see that there is definitely a standout. And this stock chart is looking at the past 2 years. We can also take a look at the past 5 years. Well, the best way that we can figure out if they're doing something different is to take a look into the ETF fact sheets. Now we'll take a look at Evolve's Divs ETF webpage. And the first place that I like to start is to see what they're holding. And we can see within the first 5 is that they're big Canadian companies, if not all of them. And they seem to have a high percentage weighting in RBC, Enbridge, TD, and Manulife. So let's take that into consideration. Let's get an understanding of what they're holding and then compare it to some of the others. So we'll jump over to the iShares product, CPD, on the Toronto Stock Exchange. And what we can see is that there are some similar names from the Evolve product, but the one that stands out most to me is that the most of their weighting is in Brookfield. So I don't know how much research you've done in the market, but Brookfield is definitely taking a little bit of a hit right now because of the office exposure / the real estate that they're invested in. Now this is focusing on the Brookfield property, which is a ETF or a product that they did buy out. So I don't know how much of a interest rate or yield that one is paying in particular, but just taking a look at some of the names that are there, and they're definitely those blue chip companies that we mentioned before. We can also take a look at TD. And this one, we can see a lot of these similar names keep reappearing with some minor variations. Past performance is not an indication of future performance, but we can go back to this Yahoo Finance to see which one has been performing relatively well in conjunction to see with how the dividend yields are and if that yield fits into your portfolio. And the most important factor is that where are interest rates going to go? If you see them going down in the next 2, 3, 4 years, then obviously we might see some capital appreciation, but you may be able to lock in this particular yield. Now, they do rate reset. I believe it is a 5-year period, but that's why I'm choosing to look at the ETF functions, because I'm going to let the people that are a lot smarter than me manage this facet of it. With that being said, after all the research that I've done in this particular video, for me, I'm not jumping into preferred shares today, but I'm definitely continuing to watch this market. Now that I've done a little bit of research on it, I understand why the market moves, how this particular asset class is driven by interest rates. It could be something that I do add into my portfolio, especially with all the volatility that's going on. The markets have been up and down, sideways. What's going on in the economy? We have no idea what is going to happen, but if I can add this 6% yield and know that they could potentially grow, this could be a contender for the portfolio. As of right now, not making any moves. We'll definitely let you know if I do get into one of these, but let me know your thoughts down below. Are you interested in this asset class? Do you have it? Is it more for fixed income portion of your portfolio, not really for growth, but to get some income into your portfolio? Let me know your thoughts. What do you think about this research? Anything you can down below, love to hear it. But if you enjoyed this video, definitely check out some videos that I've done on the Canadian ETFs on the Toronto Stock Exchange. I'll link some just right here. I hope you all have a great week in the markets. Happy trading.